Welcome to the Profitable Home Services Podcast. I'm your host, Diane Gardner, and I'd like to welcome you to another action-packed episode. Our guest today is Bill Black from Pension Specialists. Let me tell you a little bit about him. Bill has been in the pension administration business for over 40 years, and he's responsible for the marketing efforts of the firm, assisting producers nationally with the sale of qualified plans. He has a BA from Rollins College in Business Administration and Economics. He's a CLU, a CHFC, Life and qualifying member of the $1 Million Roundtable, and 20 times Court of the Table and 20 times Top of the Table qualifier. Bill brings that unique and necessary combination to the marketing effort. He's comfortable with the explanation of complex ideas and able to put them into easily understood concepts with the ability to sell. Having spoken nationally and internationally on the topics of qualified plans, Bill is a much sought-after speaker. He's certified to teach continuing education to CPAs and insurance professionals. Additionally, he has had numerous articles published in industry journals and has been featured on radio programs that address financial planning matters. He's licensed in 43 states, which makes him truly a national practice. He has marketed and administered plans in virtually every state in the union. So welcome, Bill, to the program. It's great to have you.
Appreciate you having me today. Thank you very much.
Yes, and in full disclosure, Bill and I have been working together for many years as I work with some of our small business clients with tax planning, helping them pay the least amount of tax necessary, which coincides right in with becoming profitable. Because if you're overpaying your taxes, that is a big cash flow leak and ultimately a profit leak in your business. So even though Bill's not here to talk about so much profits planning or profit savings, tax savings falls in that same arena. So Bill, over the years, I've heard you speak about this, but I thought I would ask the question that I hear people asking you all the time is, what is a qualified retirement plan and why would a small business want one? Isn't that just for those big corporations out there?
Right. That is a good question and one we hear often. And qualified plan means the contribution that the employer puts into it qualifies for an income tax deduction. And that's the only thing qualified means is your plan under the rules and regulations qualifies for an income tax deduction. But there's a lot more to it than just that. The money not only goes in there and is deductible, but once it gets into the plan, it grows without taxation because these plans are tax exempt, just like your IRA is. Under ERISA, the Employee Retirement Income Security Act of 1974, the assets in an ERISA qualified plan are protected from the claim of judgment creditors in case you're ever sued. And in today's litigious society, if somebody thinks you've got $1, they're going to try to separate you from it in a court of law. And this is why Ron Goldman's father couldn't get OJ's NFL pension because they're protected assets. And your client can build up millions of dollars in these plans. At the end of the day, roll it tax-free to their IRA account. And then whenever they take that money out, it's taxable to them as ordinary income. You can now delay receipt of the money until at least 73. You can certainly take it before that. But aren't these just for large companies? And the answer is actually no. They're fine for any type of business, whether it's a sole proprietor, a partnership, LLC, LLP, S corporations, C corporations. Really, the answer to your question is who would want to do this is anybody that's making more than they need to maintain their lifestyle. Think about, your clients that make X and they're living on 40% of it, 60% of it, whatever that is. What are they doing with that excess discretionary income, whatever we want to call it? Right now, all they're doing is paying tax on it and investing the difference taxably at the reach of judgment creditors. So by creating a qualified plan, that money goes in there tax deductibly, grows without taxation, asset protection features. And I left out the best part. These plans are literally approved in writing by the IRS with something called a favorable determination letter. So stop and think about it for a minute. There's not a company on the New York Stock Exchange, there's not a union, there's not a government agency that doesn't have a plan like this. The question is, how do we create these plans and design these plans to benefit your client, the rainmaker, the closely held business and professional practice? And that's really what our business is all about, is helping a client keep more of what he or she are making and paying less to the tax authorities.
I know one thing that I've been amazed in watching you over the years is you've been able to take a plan that maybe one of my clients have picked up from their payroll provider or somebody like that, and take a look at it, find where their weaknesses are, and then you come out the gate with this amazing customized plan for them that now is working in their favor. Can you talk a little bit
Mhm.
about that?
Yeah, so one of the things that we find is often a client will have a company from a company plan from a payroll company, or somebody put in something called a SEP for them, a simplified employee pension, et cetera. And these are one-size-fits-all plans, what we call uniform benefit plans. I kind of liken it to Henry Ford when he was first building the Model Ts. And he said, you know what, Diane, you can have any color you want as long as it's black, right? And these are the same type of plans that the client gets when they go to the payroll company. And that's where the misconception comes in. I got a 401k plan. Aren't they all the same? It's 401k. And all 401k is a section of the Internal Revenue Code. There are a lot of different ways to create a 401k plan. And it's like saying I've got a car. Not all cars are the same, right? Some are, sports cars, family trucksters, minivans, all that type of thing. And really, these plans are very much the same. So what we really do is we kind of stand back, and we don't say to a client, oh, you need a SEP, a simple, a 401k, cash balance. No. What we say is, if I could get you any type of tax deduction you wanted for your business, how much would that be? That's going to give us an idea of the right plan for your client, because in these type of plans, there are many different type of plans. There's about a dozen different types of plans. Everybody just thinks 401k, SEP, whatever. But there are many different type of plans. What plan is right for your client starts with what their deduction goal is. Let's call it a budget for a different, or for lack of a different, meaning or word. And then that's going to be the starting point on what plan is right for your client. Once we get to the budget, if I may, the next thing we do is we look at the employee makeup. How many employees do we have? Names, dates of birth, dates of hire. We run some numbers. The biggest misconception that we come across all the time is, gee, if I do this, I'm going to have so much money I'm paying the employees that it's just not going to make economic sense. And that's what you were talking about when we look at these plans and do a custom design. We've been doing this for over 40 years now. This is what we do. This is what we specialize in. And so we know all of the nuances and the real detail about how these plans work, which allows us to design the plan that's right for a particular client. And yes, they are custom designed. And that's where we kind of separate ourselves from the payroll companies. They do a good job with payroll, not so much with qualified plans.
And I know I've always am amazed when I watch the numbers that you put together for my clients. And it's like, what a difference just by changing up their plan into something that's customized for them.
Yeah, what happens is when we do this, a lot of times the client says, well, what, you're going to get rid of my plan and I'm going to have to do a new one? And no. What happens is we take the plan that they have and make adjustments to it, add and subtract features. I kind of liken it to having a car and putting on some enhancements to the engine, right, and making it more powerful. That's kind of the same thing that's happening. But there's another thing that's going on in the country right now too, Diane, and that is states that are making these plans mandatory. And there's several of them right now that have mandatory plans. For example, California has something called Cal Savers. Oregon came up with something called Oregon Saves. Virginia is going live this year. Colorado, Connecticut, Illinois, they all have mandatory plans. New York and New Jersey are coming on board soon, and all these other states eventually will be adding them. The COVID slowed it down a little bit. But for example, if you're in California and you have 5 or more California-based employees, and at least one of them is age 18, you will participate in CalSavers. You will hold 5% out of every employee's paycheck that's been with you 90 days, and you will send it into the state. And the only way to get out of it is to have your own plan. Now, here's the good and the bad. When you're in CalSavers, they say it doesn't cost you anything. Well, how do you hold money out of an employee's paycheck, send it into the state, report, oh, they're not here anymore? How do you do that without any cost, right? I mean, there's administrative costs that are involved, and nothing is deductible to the employer. So by creating a custom design plan, you can make, okay, so going back to CalSavers, somebody's been with you 90 days, they're going to come into the plan. If you do a custom design plan, you can keep the employee out for a year and make them age 21. So it helps with high turnover type of businesses. But then when you create, so how do you get out of CalSavers or any of these other state-funded plans is by having your own plan. So by custom designing a plan for yourself, you can make it deductible, you can get the bulk of the contribution going upstairs to the rainmakers, the owners, and at the same time satisfy the rules that the state has mandated. So there's a lot going on with these mandatory plans in these different states, and it's a pretty big penalty if we don't participate in their state mandated plans or prove by opting out that you've got your own plan. So that's the next thing that the small business and professional practice has to be very concerned about.
That's a huge concern because I can't imagine a state mandated plan we get you anywhere close to the same results of a customized plan.
Right, and it won't, because the employer can't put any money into it. And where we do these custom design plans, your client can get significant 5 and even 6-figure tax deductions. And when we create these plans, you know, the majority of it is going to the client, 80, 85, 90% of the contribution. And so you kind of look at it like, okay, wait a minute. Do I give the employees 10 or 15% of the contribution and get a lot of that back through what are called vesting forfeitures? Or do I give 40 to 50% to the taxing authorities and never get any of that back, right? And so these are ways that your client can pay less tax and keep more of what they're making. The clients that usually come to us, Diane, they're saying the same thing to me they're saying to you, right? I pay salary, sick pay, vacation pay, major medical, I match Social Security, unemployment, workman's comp, Medicare, and now I've got to pay a ton of money in income taxes. When do I get to do something for me? I've got my life in this business, I've got my capital at risk here. When is enough enough? And that's really what we create these plans for. I'm not going to say that we create them to plan a client's retirement. If we've got a client that's putting 5 and 6 figures away into these plans, they're really worried more about taxation. How do I keep more of what I'm making and pay less to the taxing authorities? And at the same time, satisfy these state mandated plans if they live in one of those states. And that's really what these plans are about, is the employer benefits that we can create from them, for them.
And I love the fact that you are able to build it around the employer, which happens to be the business owner,
Yes.
because that's who we work with. We're all about making that business healthier and more profitable and helping them grow and that type of thing. And I think too often the owners go without. They're the last ones to get paid. They're the last ones to be able to get vacation time. They're the last ones to do some of these things, especially in those early growth years. And so it's nice when we can create something that's pretty much all about the owner. And yes, we've covered the employees, but we're still creating it for the owner of the company.
Right. And one of the, how do I say it? One of the hurdles we have to overcome is sometimes I'll hear, you know what, I looked at these plans once before and I had to give so much to the employees it just didn't make sense. And I'll ask them, what did you see? A payroll company plan or a SAP, and it always is. And those are those uniform benefit plans that they've seen, just not knowing what else is available. And not to speak poorly of anybody, but the folks that work for the payroll companies, they know payroll. They just don't know all the ins and outs of this plan, and so they just show the uniform benefit plan, and they think they're all the same. They make everybody think they're all the same, and that's why a lot of people end up paying more tax than they need to.
This is a big area and an important area for a small
Mm-hmm.
business owner to be thinking about and considering, where am I going?
Mm-hmm.
I know it also does help them in hiring and retaining their employees, because a certain percentage, I know it's a small percentage, but a certain percentage of their
Mm-hmm.
employees are looking for this type of thing.
Mm-hmm.
And they'll look at a company who can also add in some sort of retirement planning for them. Is
Mm-hmm.
that something that's important to them?
Right. And so here's the thing. When you have a type of an industry that the employee population expects a 401k, that's all right. But the trick is how to offer that benefit so the employees can hold money out of their own paycheck, right? So that's their money anyway. How do we make that plan benefit the client that is sponsoring the plan? So that's really what we're doing, is we're saying, okay, you've got a 401k, you allow the employees to hold money out of their own paycheck. That's fine, that's their money. How do we build on top of that, right? Like plug in the extra features to the plan that allows your client to put money into these plans and deduct it. So most people think of 401k, right? So if we hold money out of our paycheck in 2023, we can hold out $22,500 from our paycheck. If we're age 50 and over, we can get a $7,500 catch-up. That means we can hold up to $30,000 out of our pay. But the company can put in enough to bring that owner's benefit up to $66,000, or with that $7,500 catch-up, a $73,500 deduction. So that's pretty good. What I always say is it's kind of like a 80-20, right? Everything's got an 80-20 rule. 80% of the clients are going to be happy with a $66,000 to $73,500 deduction. But what do we do with the client that says, Diane, that's great, but I need a deduction bigger than $73,500? And then there are other plans that you can layer on top of the 401k plan to allow them to get now up into the six-figure deductions, maybe another $100,000, $200,000, even $300,000 deduction. Now, those are big numbers, and those are very large numbers. But there are those industries out there that require that. Sadly, most of them don't realize what is out there and available because somebody's just shown them a SEP or a simple. And we've got clients that have like a simple plan. It's called a savings incentive match plan for employees. Simple is an acronym. And so they're limited to less than 25,000 of those plans. And the old saying is, they don't know what they don't know. Sadly, they're not getting they're underpowered. Their plan is underpowered, and they're not getting all the deductions that they could. And so this is where these other type of plans can really come into play and benefit your client. Mm-hmm.
Can you tell me a little bit about some more of the myths surrounding retirement planning? I know there's a lot of bad data out there.
You're not kidding. So one of the myths is, I've already got a plan. They're all the same. I've already got it covered. Well, again, that's because somebody created something for them that is a uniform benefit plan. There's something called a SEP, S-E-P, it's a self-employed pension, or it's a SEP, or a simple, a savings incentive match plan for employees. Those are actually expanded IRAs. You can download those forms for free right off irs.gov. No cost to set them up or administrate them, but they're very simple. They're very basic, and all the employees get the same benefit. And so there's not really a lot of distance that you can put in for the client. There are a lot of benefit. The others, as we've been discussing, are the payroll plans, because they usually are all the same, and the client has usually what's called a safe harbor match. You know what, if you put money in, we put money in. If you don't put money in, we don't put money in. And usually that's about kind of where it's limited. And so most people think, well, I've got that. That's all I can do. I've got it covered. And that's where really we kind of come in as you were mentioning earlier with some of your clients. For example, what happened one of the times, I think we can talk about one of your clients if we don't talk about names. You came to me and you said, Bill, I've got a client. He holds money out of his paycheck. He sends it in, and they keep sending it back to him. And, I was told that they could hold out, well, this year's limit is $22,500. He puts the $22,500 in, but they keep sending back like all of it. I mean, what are we missing here? Basic little plan design issues that we changed. And then what happened? The client could make his full salary deferral, was getting a decent employer contribution, and because there was very little employee participation, about 90% of the pie went to the rainmaker, the owner. And so it's little changes like that we make that allow these plans to give the client more incentive and benefit to do it. So the big myth is, gee, whatever I do for me, I got to do for everybody else. Not so much the truth. Ways to create these plans and skew it upstairs to the owner. And then some of these other things like a SEP, a simplified employee pension, has a weird little quirk with it. And you have to include, all your employees that have worked for you 3 out of the last 5 years. And it doesn't mean that they had to work for you a year. They had to make at least $750 to be considered there for a year. So what happens is little part-time people that come and go, you might hire them for a couple of weeks around busy season. They've got to come into those plans. Well, who's determining eligibility for those plans? Who's monitoring them to make sure the client's not? I mean, somebody set it up for them. They think that person's doing it. And so a lot of those plans aren't even what we call qualified in operation anyway. So SEPs are one of the easiest plans to improve for the client for a couple of reasons. We can take out the uniform benefit, make it a bigger deal for the client, a larger benefit, and determine eligibility properly so they're not having a disqualified plan. So those are the big myths. In particular, the other thing is, will it get a client that has a 401k from a payroll company? They make their full salary deferral, and then they get a match. That match is limited to 4% of pay. So I don't care what your client's making. Let's say round numbers, 100,000, because I can do those numbers in my head. They hold out 22,500 from their paycheck. They put in the safe harbor contribution, which in this example is 4% of their W-2 income or their earned income. Let's say it's 100, there's another $4,000. They've put in their salary deferral of 22,500 plus 4,000, there's $26,000. And I'll say, well, wait a minute, you can put in 66,000. No, I was told all I could do is my salary deferral and my match. That's another myth. The people that put these plans in don't know all the nuances, and so they'll just tell the client, all you can do is your deferral and your match, not knowing that there are other forms of employer contribution that can bring them up to that 66, 73,000 and above numbers. So that's really the biggest myth that I've seen is whatever I do for me, I got to do for everybody else, and the unnecessary belief that they are limited in what they can do.
That's a really big myth because I run into those all the time when I'm working with small business owners and home service business owners, that they think that what they do for themselves, they have to do for their employees. And so at the beginning, they're not real sure they want to even walk down this road.
Right.
But once we have a meeting and can kind of show them how it can work, not that it has to work this way, but here's some options, it seems like the light bulb goes on. And now they're willing to take a look at this and, ooh, I kind of like this. Let's have a second meeting. Let's explore this some more.
Yeah. And how we do it is we get a little bit of information from the client, a census, right? Names, dates of birth, dates of hire, estimated W-2 income for the year, and a little questionnaire. And we put some numbers together so you and the client can look at it, make a business decision on what's right for them. So we'll put those numbers together, review it, and I always say, you're either going to go, this is the dumbest thing I've ever seen, or I love it. There's really not a lot of in between. It's like being pregnant, right? You either are or you aren't. Here, you either like it or you don't like it. It either works or it doesn't work. There's not really a lot of in between. No cost to look, but at least the client has the information. They can make a business decision on what's right for their particular situation. And the plans can be created with a lot of flexibility. So what happens now, and this is the greatest thing, there's been a lot of changes to pension law in the recent past. The greatest thing is you can still create a plan for last year. So wait, what do you mean? 22 is a closed year, isn't it? No, you can create a plan up until the deadline for filing the client's tax return, including extensions. So now that 22 is over, you get to close the client's books, start to review their tax program with them. Now it's June, they're halfway into 23, they see what 23 is looking like. Ooh, if I do this, I get to knock down 22's taxes. And look, 23 is actually being a pretty good year. I've got the revenue to do it for 23. I can mitigate that. And even though it's an expense on the books, it's really money that's going into the client's account. So this is a great change, which allows us to really, have more financial information to create these plans for the client and still save money for last year. And these plans are going to be created so there's a level of flexibility to it. So it's not like I've got to cut this amount every year. And why is that important? We live in a cyclical society. So not every year is 12% better than the last. Maybe this year the client's got a down year, or maybe not. Maybe the cash is just being applied to acquire a competitor, buy extra equipment, or whatever cash needs a client might have. This particular year, maybe they don't want to make a contribution to the plan for whatever reason. These plans can be designed so they're highly flexible and not a big and significant contribution to the plan, somewhat reasonable. And, that's all part of what's analyzed prior to any commitment being made, so they're fully aware.
So let's say one of these home service businesses that are listening to this episode are interested in setting up a plan. How do they even go about starting one?
So the first thing to do is see if it makes sense for the particular business profile. So how do we do that? We prepare illustrations of costs and benefits so that the client can make an informed business decision. Now, when these plans are created, not only does the client get a tax deduction for the contribution, but there's been a big change under the recently passed Secure Act. The client not only deducts the cost to set the plan up as a professional fee, but there are actually tax credits for creating the plan, and for the contributions that the client makes for the employees, up to $1,000 per employee. So think about that. You could get a deduction for creating it, you get a tax credit for creating it, and a tax credit for employee costs to a maximum of $1,000 an employee. These plans actually start paying you to create it. But to look at it, there's two things you might want to do. Have a second opinion on the plan that's in place now. And you know what? We're not using the same cell phone we were using 10 years ago, are we? So why do we think that plan we set up 3, 8, 10 years ago was still proper and the best design? Demographics of our employee population changes. We might have more employees, we might have fewer. It's always good to get a second opinion. So if I could plug my website, you just go to pensionspecialist.net, and on there is a little section that says request a prepared illustration. And we just need the census, the questionnaire, and if there's an existing plan, something called the adoption agreement. And from there, we just put numbers together that basically is, look, this is what you have. This is what we would recommend. Here's the difference. And just see if it's right for you. It's just that simple.
Bill, how long does this normally take to get a business up and running with a plan?
So if we got the census today, we would have numbers to review within 5 business days. The client looks at those numbers and usually will say, this is great, or what if we did, this, give a little bit more to this person, a little bit less to that person, that type of thing. Go back and refine it. Okay, so now it's been, let's say, 10 days. Client says, yes, I want to move forward. Well, every pension plan, 401k plan is a trust. These are actually tax-exempt trusts. When the client puts money into it, it goes into that trust account, and the client is the trustee. So the client is really the only one's signature power over the money. So we create all of the legal documents necessary to create the plan and give it life. And then we have to open up an account in the name of the plan because the money has to have some place to go. So we do all of that paperwork. That takes about 2 weeks. And then the account has to be open. And so that can take another 2 weeks, sometimes 3, to get the account opened, because today, with the Patriot Act and these others, all of the know your client, has to make sure that this is a real pension plan, et cetera, all those money laundering laws that we're being constantly bombarded with as advisors. We have to make sure this, that, and the other. So we have to open that account. So from start to finish, we're talking probably about 30 to 45 days.
Okay. That's good information to know, because sometimes we get under a time crunch. And I think I run into a couple of those with you. But now that the laws changed, we're not quite so stuck on an end of the year deadline or some of those types of dates that we used to have to work with.
Yeah. So now we have until September 15th. That's the good news and bad news. The good news is you have until the deadline for filing your tax return, including extensions, to get it done. The bad news is we still need time to get our paperwork done. So I tell people, if you come to me on September 14th, we're not going to have time to get it done. So I'm telling people really August 14th is the decision deadline day, so that we can draft all of the paperwork to make the plan come to life, get the accounts open, and then have some place for the money to be contributed by September 15th.
You guys are miracle workers. When I sit back and watch how you pull these things through and get all the signatures and stuff that you need and push through the amount of paperwork that you push through to get these plans open.
Yeah, and then what we try to do is something that's a little bit different than others, is we try to take a lot of the heavy lift off of the client. And you have to have eligibility determination. How do we become eligible for the plan? Generally speaking, you have to work a year. You have to work 1,000 hours within that 1-year period. And then you come in the next following January 1 or July 1. So that is a way to keep the employees out as long as possible. Why do we do that? Because these plans, one thing when you bring the employees in, it's really a reward for long and loyal service. It's not a bonus. It's not a cash gift. So if the employees are going to stay, those are the ones that make the wheels turn, right? Those are the ones we want to reward. For those that come and leave 3 months later, 9 months later, really they weren't a team player. So we try to eliminate as much of that as possible. Some people say, look, Bill, in my industry, and I had a client like this yesterday, he goes, that doesn't work for me. I got to have pretty much immediate eligibility. That's fine too. These are the things we get into to custom design these plans to fit the client's needs. Now, the next thing is, does the client really want to sit here and figure out who's eligible and when? No, we do that for you. And if we have a dual entry date like January 1 and July 1, about 30 days ahead, we send out a note that says, open enrollment is coming up. We'll do the open enrollment for you. These are the new participants. And we'll do a Zoom meeting where we explain the plan to the employees and show them how to enroll in the plan. So when a plan is created, we have an enrollment meeting, and then every enrollment, twice a year, we have an enrollment meeting where we explain the plan. What about people that are already in the plan? They might have questions, right? So all of this is done. And then once a year, we get an updated census. We calculate the contribution, discuss it with the client, and then work with them to electronically transfer the money to the plan. They sign I don't want to call it a tax return, even though it looks like it, because the plan is tax exempt. It's an information return. We send that to them for signature, and then we file it for you electronically. So we try to keep these things to a minimum. There still is work that the client needs to do, which is give us a census once a year, make the contribution timely, and sign the paperwork that's sent for signature. Other than that, we try to take as much of it off their shoulders as possible because they don't need extra work. They've got their own business to run.
They do, yes.
Mhm.
And when it's not something you do day in and day out, it's easy
Right.
to forget those things. And that's
Mhm.
another area that I've been so impressed with you guys compared to a couple other providers that I have clients that have plans with, that they
Mhm.
never ever contact the client. And I'm the one driving it
Mhm.
as far as figuring out what's their employer contribution going to be and that type of thing. And I don't have to do that when I work with plans that you guys are handling. You're already meeting with the client, you're telling me here's how much they're going to be putting in. And as the accountant, I appreciate that more than you know, because
Mhm.
during tax time is not when I want to start having conversations
Oh yeah.
about who's going to
Mhm.
put so much into the plan and who's going to do a matching and who's not, and just all those things that go into coming up with that number.
Mhm.
So
Right.
world of difference in working with pension specialists versus working with some of the other companies that we've worked with.
Thank you.
So yes, I don't tell you often enough how much I appreciate that.
Well, appreciate you. Yeah, we just try to make uh, the work uh, non-frustrating, not a lot of extra work, and just give the client the tax benefits and the better job. I say it's a lot from a man's point of view, like buying a suit, right? You can go to the store and buy the one off the rack, or you can get a custom design one with your own lapels, the own lining, the buttons, the threads, and the price is the same. Which way do you want to go, right? And that's the other thing that surprises people is our fees often are similar or less than the payroll companies are charging. And in fact, I've got a client I'm working with right now who has one of those online 401k people that there's no human interaction. Everything is done, on a portal or on email. And it's just frustrating because he doesn't have any human, with our plans, you have one person you talk to that knows your plan intimately that you can call and say, oh, I've got this question. These online providers, they say, oh, we've got an inexpensive business model, but you can't get to anybody. And he says, I'll move to you if your price is the same. Their prices are posted right on the internet. And believe it or not, ours are the same as theirs. And with the payroll companies, you could just look at it and do a side by side. Ours are typically less than the payroll companies. So just to toot our own horn, I guess, you get a better mousetrap for the same price and
Mm.
more, personal touch.
Well, and then to bring that back around to our profitable home services theme is by working with a custom company, we're able to recoup some profits that are probably leaking out in the form of not being able to take advantage of the plan completely and not knowing what you don't know. You
Mm-hmm.
don't know what you don't know. I didn't word that well.
Yeah,
Anyhow, but not knowing enough to even ask the questions.
yeah,
And in the case of some of these other providers, because there isn't a person, a human that they're interacting with, that even more complicates asking any questions.
mm-hmm.
So that does become a potential profit leak for people.
Yep, yep. And the other thing to think about, if you're in a state like California where state and federal income tax, New York, New Jersey, you're approaching 50%. If you put $100,000 into a plan like this, really you just saved yourself $50,000 in income taxes. You put 100,000 into a plan like this and it's deductible. You've got 100 going to work for you. If you don't do a plan like this, you've got 50,000 net in your pocket after taxes. So it's almost like doubling your money just by creating a plan like this because of the tax benefits. Now, some people say, well, yeah, but you're going to pay the tax now or you're going to pay the tax later. I just pay the tax now. The thing about it is, if you pay the tax now, you've got 50 cents working for you and you're investing that taxably, and those earnings are going to tax. If you put that 100 into the plan, you've got twice as much working for you. If you have the same rate of return, let's say 5%, you're actually making twice as much because you got twice as much working for you and those earnings aren't being taxed. Well, wait a minute, I got to pay tax in the future. Yeah, so you're going to build up $1 million, $2 million, $3 million in this plan and roll it over tax-free to your IRA. It's going to keep growing on a tax-deferred basis. Now, how are you going to access that money? You're not going to take it all at once. You're going to take it out over time. And as you take it out, the balance of the money is continuing to grow on a tax-deferred asset-protected basis. You're always better off. deferring those taxes, because when you take it out, you don't take it all out at once. You take it out a little bit at a time. And so you will always end up paying less in taxes and have more in your pocket. And I've done spreadsheet after spreadsheet on that. And it's just the way it is. I could review that with the naysayers, but it's a fact.
And that's where your accountant comes in too, to help you plan how much you
Right.
should take out so that you don't bump yourself up into the next tax bracket or that type of thing. Where are the bumpers? And stay within those bumpers. And then that allows you to save some more because you're not paying more tax than you really have to pay. So,
Yes, ma'am.
yeah. Well, Bill, thank you so much for being on our program today. It's been a pleasure getting to learn a little bit more about retirement planning and a qualified plan versus an unqualified plan, and how a home service business can really benefit from taking advantage of a tax saving strategy, which also rewards not only the business owner, but some of their employees as well. So
Right.
thank you for being on the program today. And if somebody wanted to reach out to you, would you like to go ahead and mention your website one more time for us?
Sure. It's pensionspecialist.net. And we have a toll-free number, 888-412-4120.
And just for those who are listening, Bill does work in almost all the states, which is one of the reasons I love working with him, because I've got clients all over the US. And I know I can call Bill and he'll have somebody that can help them in that particular state. So that's been great.
Yes, ma'am.
All right. Thank you, everybody, for joining us on this episode of the Profitable Home Services Podcast. Be sure and check back for our next episode as we bring you another amazing industry leader guest, or potentially another home service business who is willing to share their successes in their business. So we'll catch you on the next episode. Until then, have a great day.
Thank you again.
Okay.
All right. So if you want, I guess we're done, right? With the yeah. If you want, I can have like a little placard or something put up that just has my email and webpage on it, and name and phone, if you want to just flash that on the screen or something.
All that'll be in the show notes.
Oh, okay.
Yeah.
Okay. Very good.
So yeah, well, my team will type all that up and have that ready to go with the episode, as well as your picture. And I think they'll probably shorten up the bio just a little bit, and they'll put that in there. So that people can get to you easily.
All right.
Okay. All right. Thank you, Bill, for joining me today. It's been a pleasure.
Oh, thank you so much. Appreciate you having me.
All right. Thanks.
Okay.
Bye-bye.
Bye.